Welcome to Factful Finance, where we break down the concepts that power your financial future. Today, we're diving into a concept that's crucial for anyone making investment or corporate finance decisions: the weighted average cost of capital, WACC. Stick around because this is going to unlock a whole new level of financial understanding. Ever wonder how companies decide whether a project is worth pursuing, or how investors figure out whether a stock will give them a good return? WACC holds the key. It's the threshold for investment success, and understanding it can completely change how you look at risk, return, and the cost of capital. But here's the thing: most people, whether they're new to finance or seasoned pros, underestimate its importance. What if I told you that missing the mark on WACC could be the difference between profitable investments and financial disasters? Let's break it down. The weighted average cost of capital is essentially the average rate of return a company is expected to pay to finance its assets, weighted by the proportion of debt and equity it uses. Sounds technical, right? But once you get the hang of it, you'll see how pivotal it is to both company performance and investment strategies. Now, let's bring it down to earth with a real-world example. Imagine you're Liam, a savvy investor. You're considering investing in a company called Horizon Tech. Horizon Tech has a 60% debt to 40% equity structure. If their debt costs 5% and their equity investors expect a 12% return, WACC is your magic number to figure out what return they need to generate on any new project to satisfy both types of investors. So here's the formula: WACC equal V RE plus DV RD 1 minus TC, where EV equals the percentage of financing that comes from equity, D equals the percentage that comes from debt, cost of equity, RD equals cost of debt, TC, corporate tax rate, because debt interest is tax deductible, reducing the actual cost of debt. Let's plug in some numbers for Horizon Tech. With 40% equity, 60% debt, a cost of equity at 12%, a cost of debt at 5%, and a tax rate of 20%, you get a WACC of approximately 7.8%. What this means is, for Horizon Tech to create value and justify new investments, their projects must deliver a return greater than 7.8%. Now, the impact of WACC goes way beyond this simple formula. It's a guidepost for corporate investment decisions, project evaluation, and even mergers and acquisitions. If a project's expected return exceeds the WACC, it creates value for shareholders. If it falls short, well, it could be a sign of a bad investment. Understanding WACC helps you as an investor too. Think of it as your compass for navigating the stock market. When companies' WACCs are high, it suggests that the cost of capital is high, possibly indicating more risk involved. A lower WACC could indicate a more stable investment, but it's all about the context. Here's the bottom line: mastering WACC isn't just a technical skill, it's a financial superpower. It empowers you to evaluate investments like a pro, assess risk, and make smarter financial decisions. So the next time you hear about a company's financial performance or investment opportunities, you'll know exactly what to look for. And if you're wondering how to apply this in your own investing journey, remember, the fundamentals matter. WACC helps you measure risk and determine whether a company's returns are worth your hard-earned money. Want to take your financial decision-making to the next level? Keep watching. There's more to uncover. And before we go, if you found this breakdown helpful, drop a comment below. What's your biggest finance question right now? I'd love to hear it. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance.